Hello, everyone, and welcome back to What Changes. I am your host, May. Today, we are diving into a topic that sits at the terrifying intersection of advanced technology and global finance. We are looking at a future where artificial intelligence doesn't just automate our jobs, but potentially dismantles the trust that holds the global economy together. We are also going to discuss a massive shift in the gold market, a potential $10,000 price tag, and a secret financial weapon that the Trump administration might actually use to reset the US debt. Before we begin this deep dive, I want to invite you to join our growing community on Telegram. It is the best place to get updates that don't always make it to YouTube. You can find the link right down in the description below. Also, stay tuned for a very specific book recommendation later in this video that explains the crisis we are walking into. Let's get right into it. We often worry about a financial crisis or a monetary reset, but what happens when you introduce artificial intelligence into a fragile economic system? According to macro-economist and best-selling author Jim Rickards, we are facing a race to collapse. The question is, what breaks first? Does an AI-triggered meltdown crash the system, or does a global monetary reset happen first? Rickards warns that while a monetary crisis where banks fail and credit dries up is sneaking up on us, and is perhaps more likely to happen sooner, AI could be the accelerant that turns a fire into an inferno. Imagine a scenario where the monetary crisis begins, banks start to wobble, and then AI amplifies that collapse. This is the worst-case scenario. We are entering an age where digital assets can vanish in an instant. Rickards notes that nothing will accelerate a move toward hard assets faster than the realization that digital wealth is ephemeral. When the robots take over the trading systems, circuit breakers, those tools designed to stop market freefalls, may no longer work. So, how do we protect ourselves? And why are the world's most powerful central banks hoarding gold like never before? To understand this, we have to look at the startling prediction Jim Rickards has made regarding the price of gold. He has stated, quite boldly, that he would not be surprised to see gold hit $10,000 per ounce before the end of 2026. Now, that sounds like an impossible jump, a doubling from current levels in a very short time. But Rickards argues this isn't just speculation. It is based on fundamentals and simple math. Let's break down the fundamental case first. The primary driver here is the behavior of central banks. For decades, from 1970 until 2010, central banks were net sellers of gold. They were dumping it. The US sold thousands of tons in the 70s. The UK famously sold a third of its gold at the bottom of the market in 1999. Switzerland sold 1,000 tons in the early 2000s, but in 2010, everything flipped. That was the inflection point. Since 2010, central banks have become net buyers. We aren't talking about the Western central banks buying, though. The buyers are Russia, China, Turkey, and Iran. These nations are savvy buyers. They buy the dips. Russia, for example, did a brilliant job between 2009 and today, essentially quadrupling its gold supply from 600 tons to 2,500 tons. They did this quietly, steadily, without disrupting the market. This massive accumulation of gold is actually one of the reasons the Russian economy survived Western sanctions. They had 25% of their reserves in physical bullion, stored safely within their own borders. While the West froze their treasury securities, the value of Russia's gold tripled, offsetting their losses. This central bank buying puts a floor under the price of gold. It creates what Rickards calls an asymmetric trade. You have limited downside because these massive sovereign buyers are waiting to scoop up any drop in price, but you have unlimited upside. Combine this with the fact that global mining output has been flat for 6 years, hovering around 4,000 metric tons per year, and you have a classic supply and demand squeeze. Demand is rising from the biggest players in the world, and supply is stagnant. But how does it get to $10,000 so quickly? This is where behavioral psychology comes in. Rickards explains a concept called anchoring. Humans get fixated on specific numbers. When gold moves from $2,000 to $3,000, that is a 50% increase. That is a heavy lift for the market. But as the price gets higher, the percentage gain required to hit the next milestone gets smaller. Moving from 9,000 to 10,000 is only an 11% gain. In a momentum-driven market, that can happen in a single month. Professional traders understand this. While the general public sees a daunting number, the market sees smaller and smaller percentage hurdles. The move from 5,000 to 10,000 happens much faster than the move from 1,000 to 2,000. Furthermore, we haven't even seen the retail frenzy yet. Think back to 1980. People were lined up around the block to buy gold. You saw gold chains being snatched off people's necks in the streets of New York. That was mania. We are not there yet. The current buying is institutional. If a geopolitical event or a war triggers the public to panic buy, we could see that $10,000 target hit even faster than predicted. Now, there is another card on the table, one that could be played by a new administration. This is perhaps the most fascinating part of the current economic landscape. There is speculation that the Trump administration could revalue gold to solve, or at least bandage, the US debt problem. Here is the context. The US Treasury officially owns over 8,000 metric tons of gold. However, on their books, they value this gold at $42.22 per ounce. That is a price setback in 1973. It is completely divorced from reality. The speculation is that the president could use the Gold Reserve Act to reprice America's gold to current market levels. Rickards gives this a probability of over 50% under a Trump administration. It is a legal maneuver. It has been done before, specifically in the Eisenhower administration. Here is how it works. The gold is technically owned by the Treasury, but the Federal Reserve holds a gold certificate, a piece of paper that represents that gold. Currently, that paper says the gold is worth $42 an ounce. The Treasury could instruct the Fed to mark that certificate up to market value, say $5,000 an ounce. This is just an accounting entry, but the result is that the Federal Reserve would have to credit the Treasury's bank account with the difference. Instantly, out of thin air, about $1 trillion would appear in the Treasury's checking account. They could use this money to fund the government without issuing new debt, effectively bypassing the debt ceiling fights in Congress. It sounds like magic, but it is standard central bank accounting. Would this change the price of gold in the open market? Technically, no. It's just bookkeeping. But psychologically, it would send a massive signal to the world. It would tell global markets that the United States government is finally treating gold as a monetary asset again. It validates gold. And if you validate gold as money, you might just trigger that retail frenzy we talked about earlier. This brings us to the geopolitical chessboard. Specifically regarding China. We know China is buying gold. Official numbers say they have around 2,800 tons. But Jim Rickards, along with many other analysts, believes the real number is much higher. China operates a state administration for foreign exchange, or SAFE, which buys gold off the books. They likely accumulate thousands of tons through this agency, and then, every few years, transfer a chunk to the central bank's official balance sheet. It is a shell game designed to hide their true strength. There is a lot of talk about the UN replacing the dollar as the global reserve currency. Rickards dismisses this. He argues that to be a reserve currency, you need a massive liquid bond market where other countries can park their savings. China does not have that. There is no rule of law, and their bond market is not liquid. Therefore, the UN cannot replace the dollar in that sense. However, the BRICS nations, Brazil, Russia, India, China, South Africa, and others, don't need a new currency to bypass the dollar. They already have one. It's called gold. They can trade in their local currencies and then settle the net differences in physical gold. Gold acts as the neutral reserve asset. It creates trust in a system where there is none. This is why we are seeing a bifurcation of the global monetary system. The East is moving toward gold and tangible assets, while the West is still playing games with debt and paper. This transition to hard assets is happening just as we face a new, unprecedented threat: artificial intelligence in the financial markets. This is the core theme of Jim Rickards' latest book, Money GPT. The danger of AI in finance isn't that the AI will malfunction. The danger is that it will function exactly as designed. In the past, human brokers and traders had different views. Some were buyers, some were sellers. That diversity created stability. Today, financial advisors and huge hedge funds are all using the same AI models, optimized for the same outcomes, using the same data. This creates what is known as the fallacy of composition, a strategy that works for one person, like selling stocks when the market dips, becomes catastrophic if everyone does it at the exact same time. If the AI models all decide to sell simultaneously, there are no buyers. The market goes straight down. It crashes through the circuit breakers. Liquidity vanishes instantly. Rickards paints a chilling scenario that is entirely plausible with today's technology. Imagine a deep fake video of Federal Reserve Chairman Jerome Powell. In this video, the AI-generated Powell gives a speech delivering disastrous news about the economy. The voice is perfect. The mannerisms are perfect. The video is released on a hacked version of the Fed's website or picked up by high-speed trading algorithms that scrape news headlines. In the age of AI, trading computers react in milliseconds. Before any human can verify that the video is a fake, the algorithms have already dumped billions of dollars in assets. The market crashes, and this isn't just a glitch, it could be a weapon. Rickards describes a scenario where foreign adversaries, like a Chinese cyber warfare unit, use such a moment as a force multiplier. They wait for a day when the market is already weak, and then they launch a deep fake or hack order entry systems to amplify the panic. They push the market over the cliff. This is not science fiction. The technology for deep fakes exists. The automated trading systems exist. The geopolitical hostility exists. We are looking at a world where reality itself, the trust that money is based on, can be counterfeited. And this leads us to the concept of moneyness. We think we know what money is, but as Rickards points out, even the Federal Reserve has multiple definitions of money supply. In a digital world where bank deposits are just bits of data, and where AI can manipulate the perception of value, trust becomes the only thing that matters. When trust breaks down, whether through a banking crisis or an AI-induced panic, the value of that digital money evaporates. We revert to what has always worked. We revert to gold. Rickards uses a great metaphor. The fish doesn't know it is in water until you take it out. We are the fish, and we are swimming in a digital, electronic, AI-mediated environment. We take it for granted. We assume our digital bank balances are real. We assume the news we see is real. But an AI financial crisis would be like draining the water. Suddenly, we would realize that the only things that are real are the things we can touch. So, what is the solution? How do you prepare for a world where AI could crash the market in minutes, or where the dollar is being debased to oblivion? The answer, according to Rickards, is true diversification. Most people think they are diversified because they own 50 different stocks. But if the stock market crashes, all those stocks go down together. That is not diversification. True diversification means owning asset classes that are not correlated. This means holding some cash, specifically treasury bills, which give you the optionality to buy when everything else is cheap. It means holding real estate or farmland, productive, tangible assets. And crucially, it means holding gold. Rickards recommends a 10% allocation to physical gold bullion, not paper gold, not ETFs, but the actual metal. Why? Because it cannot be frozen, it cannot be hacked, it cannot be erased by an AI glitch or a banking failure. It is the ultimate insurance policy. If we look at the banking system, the risks are already there. Rickards mentions that a global monetary crisis could happen because there is actually a shortage of real money, the useful capital created by commercial banks. Banks are contracting. They are fearful. This credit contraction often precedes a crash. If banks start to fail, and then AI algorithms amplify the panic, we could see a collapse of the digital financial system that happens too fast for regulators to stop. We are also seeing a societal shift. The digital world is becoming exhausting. People are addicted to screens, walking into traffic because they can't look away from their phones. But there is a limit. Rickards suggests that the pendulum might swing back. We might see a return to human interaction, to reading physical books, and to valuing physical assets. The more artificial the world becomes, the more valuable reality becomes. In conclusion, The warning from Jim Rickards is clear. We are facing a convergence of threats. We have a debt-laden monetary system that is desperate for a reset, possibly through a gold revaluation. We have geopolitical rivals aggressively accumulating gold to insulate themselves from the dollar. And we have an AI-driven financial market that is faster, more homogeneous, and more fragile than ever before. The black swan isn't unforeseen anymore. The pieces are in place. The AI threat to the markets is here. The question is not if a meltdown will happen, but when. And when it does, the investors who failed to account for this reality, who stayed entirely in the digital casino, will suffer the most. As Jim Rickards says, the race is on. Will it be a monetary reset or an AI collapse? They might just trigger each other. But in either scenario, the answer seems to be the same. Get out of the digital illusion and get into real assets. If you want to understand the mechanics of this AI threat in detail, I highly recommend checking out Jim Rickards' new book, Money GPT. It lays out these scenarios in a way that is both terrifying and necessary for anyone trying to preserve their wealth in the coming years. Thank you for watching this deep dive on what changes. Please do not forget to join the Telegram channel linked in the description to stay ahead of the news that matters. I'm May, and I will see you in the next video.